So everyone's aware of who Tom is and why he's presenting today. He's our newest member of ABC's Legal Action Committee, and he works for Seattle-based law firm Harper Hayes. His practice focuses on policyholder coverage and bad faith litigation, assessing businesses, contractors, developers, homeowners associations, and other commercial policyholders establishing coverage, and navigates the complexity of coverage disputes. Tom, how is that?
That's perfect. Yeah.
Accurate. Wonderful. Today, he's going to take us all through different kinds of coverage that's available to contractors, how those coverages work, and then common coverage pitfalls, and what to do when an issue does arise. So with that, Tom, I'll kick it over to you. And Tom, for questions, do you want people to wait till the end? Do you want them to hop on and put their hand up or throw them in the chat? How would you like to do that?
Yeah, why don't we throw them in the chat during the presentation? If I see something come up and I feel like I can address it without interrupting too much, I'll do that. We've got a 2-hour block. Probably makes most sense for some of you folks for us to hold it to the end in case you need to log off early and you're not interested in the Q&A. That gives a little bit more flexibility, I think. So preferably hold it to the end, but if you want to try and throw it in the chat in the meantime, I might address it if I notice it and I can address it quickly.
Okay, that sounds great. All right, with that, I'll turn it over to you. Thank you.
Perfect. Thank you, Sophia. I appreciate it. And thank you everybody else for joining me here today. I know it's probably not easy to hop onto your computer and log on and get excited about learning about insurance. It's not the most interesting topic, but we'll try and keep it interesting. We'll try and keep it fresh. I can't promise that you'll be entertained, but I'll do my best. So just a little bit more about me, so you know who I am. So as Sophia mentioned, I'm an attorney. I work for Harper Hayes, which is a law firm in downtown Seattle. I've been practicing for about 12 years. 8 of those years have been with Harper Hayes, where we primarily focus on insurance coverage work, where we represent policyholders. There's really 2 types of cases that we typically handle. One, probably most relevant to you folks, is we do a lot of construction related insurance coverage work where we represent contractors, subcontractors, developers, owners in disputes against their carriers when they've been denied coverage, or maybe they got defense to a lawsuit and the ROR, reservation of rights letter, is a little fishy, maybe indicates that they're not going to cover things down the line, and we can hop in to try and keep the insurance company in line, file a lawsuit. We do a lot of bad faith litigation. There's that component. I would say that's roughly 50 to 60% of our work. The remainder, we typically represent building owners, condominium associations, things like that, in lawsuits against their property insurance company. But even those cases typically involve some aspect of construction to them. So being in the Pacific Northwest, commonly what happens is a building owner will be doing something. They'll find a whole bunch of hidden damage somewhere that they didn't know about, and then they'll suddenly have a multi-million-dollar repair and be looking how to fund it somehow. They'll send something to their insurance company and get a denial or something like that, and they'll reach out to us and take a look, and we'll take a look and see if there's something to warrant a pushback there. So those are typically the cases that we handle. Harper Hayes is a pretty small firm. There's only 4 attorneys and 2 paralegals. But there's not a whole lot of folks that do what we do, insurance coverage work, especially on the policyholder side. So we're small, but we're aggressive, we're fast. We've all been doing it for a long time. Greg and Todd of the Harper and Hayes have probably combined 40-45 years between the 2 of them. And I think we get a lot of good results, help people resolve issues with their insurance companies, help fund lawsuits getting settled, help fund settlements, and then we've made some good case law over the years at the higher courts. So what we're going to learn about today, and I'm going to throw my presentation up on the screen here. I thought it would be good to kind of give you folks a primer on how insurance works in the construction industry, and looking at a couple of things. The first is kind of how to understand insurance when you're first buying it. You know, maybe you're a new company, or maybe you've got a new project coming up and you need to get coverage to make sure you're covered for that project. Things you want to look out for when you're entering into that market, or maybe even reassessing your current insurance suite to make sure that if something does arise, the problems are going to be minimal. And then that'll be most of the first part of the conversation. And then the second half, we'll talk a little bit about, when a problem does arise, what things you can do to keep an eye out for ways you can trigger insurance, even if your insurance company is saying, no, you don't have coverage. At least get an idea for whether or not there might be a potential for coverage there. Okay, and with that, let's get started. So there's really two different types of insurance that are relevant to probably all of you, and that's liability and property insurance. We're going to spend a good part of the first part of the day talking about liability coverage, which is your third party coverage. And by third party, what that means is that if you have coverage under this policy, the insurance company is not going to pay you anything. What they're going to do is they're going to pay money to third parties on your behalf. So there's two types here. This is your CGL, or commercial general liability policy, and your professional liability policies. And what these policies typically do is, if someone is making a claim against you or has filed a lawsuit against you, you can tender to your liability carrier and say, hey, I've got this issue. Will you please defend me, hire an attorney to defend me, and pay to get this problem off my back? That's your liability. You're not going to see a dime, but you're not going to have to pay anything either if you have full coverage. The other type of insurance is property insurance, and this is called first party, because when the insurance company owes you money, they're going to pay money directly to you. The money is not going to go to some third party, because in these instances, what's happened is there's been some sort of damage to property on the project, or to the property if you still own it. And then you're saying, hey, insurance company, I want you to pay to fix this damage. So there's two real types here. There's your builder's risk, and there's your property insurance. Builder's risk coverage typically is what's going to cover a big project during the course of the project. And then property coverage, property insurance, is what's going to cover the building after it's been completed. And we'll talk about those a little bit later today. So starting with your general liability insurers, they have three primary duties that you need to keep in mind. The first is that they have a duty to defend you against a lawsuit or a claim that's been asserted against you. The second is they have a duty to do what's called they have a duty to indemnify, or a duty to I guess there's a typo there. It's a duty to indemnify. That means a duty to pay you money, or to pay money on your behalf to settle a lawsuit, or to pay the ultimate judgment against you at the end of the day. And then finally, the insurance company has a duty to attempt settlement. And we'll talk about that in a minute. But basically what it means is that if it's pretty clear that you have some sort of liability, you did something wrong, and the person who's coming after you, they're entitled to some sort of money, the insurance company has a duty to try and resolve that action quickly, so that you're not sitting there languishing for, lawsuits in the construction, they can go on for 1, 2, knock on wood, 5 years sometimes. And to be stuck with that, it's going to disrupt your life, going to disrupt your business. The insurance company can't put you through that if it's pretty clear that you're going to have some liability at the end of the day. They've got a duty to try and settle it. And on top of all the disruption to your life, it could also impact your license, all of those types of things. So the duty to attempt settlement is often overlooked, but I think it's a very important duty to keep in mind when you have an issue like this. All right, so I apologize. We're going to start looking at policy language now. So where do these duties come from? The block quote you're seeing on your page right now, I've taken from a typical insurance policies, what's called an insuring clause. This is the part of the policy that tells you what the policy covers. It's usually pretty short, and then it's followed by a very long list of exclusions. But this is usually the first part you'll see in your policy. And this is where you get your duty to defend and your duty to indemnify. And so I've underlined the second sentence here because that's where the duty to defend comes from. And it's fairly clearly stated. It says, we will have the right and duty to defend the insured against any suit seeking damages, the damages that are listed up here, which we'll talk about momentarily. The most important thing to keep in mind about the duty to defend is that it is incredibly broad. There's not a word to describe how broad it is. And what I mean by that is that Washington courts, including the Wu case I've cited here, have continuously held that a policy, the duty to defend is triggered anytime there's even a potential for liability under the policy. So if there is any construction of the allegations that have been asserted against you that could possibly be covered by the policy in any way, shape, or form, then the insurance company has to hire you an attorney and has to defend you against those claims. So I practice pointer on this point. If you've got a claim being asserted against you or a lawsuit being brought against you, and you receive a denial letter saying we're not going to hire an attorney, you should always be skeptical. Talk to somebody to get a second opinion about whether or not you've got recourse and whether or not you agree with them. Because unless the complaint against you has been very poorly drafted by a plaintiff's attorney, it's very unlikely that you are not entitled to a defense. So the duty to indemnify, again, we're looking at the same block of language from a policy, comes from this underlined sentence here. It says, we will pay those sums that the insured becomes legally obligated to pay as damages because of bodily injury or property damage to which this insurance applies. That's where the duty to indemnify comes from, because this is where the insurance company has the duty to pay damages. Now, unlike the duty to defend, the duty to indemnify is much more narrow. It only applies if the claim is actually covered by the policy. And what I mean by that is, regardless of what claims were asserted against you at the beginning of a dispute, some of those claims might have dropped off by motion practice, or maybe the plaintiff doesn't really pursue those claims against you. Then you're left with whatever's left. And if it's clearly excluded by the policy, then the insurance company might not owe you the coverage there. All right. So the duty to attempt settlement, there's really 5 different obligations the insurance company has here. The first is that they have an obligation to conduct a reasonable investigation and evaluation of the claim that's been asserted against you. The second thing that they have to do is they have to make a good faith effort to settle the claim if the investigation that they perform discloses a likelihood that you will be found liable. Now, this is a really important point, because like I said, these what we call underlying cases, because we often handle an insurance lawsuit while one of these construction defect lawsuits are going on in the background, they can last years and years. And if an insurance company is defending you, but saying, hey, we probably aren't going to indemnify you at the end of the day because you have all these potential issues with coverage, they still have the duty to attempt settlement. And if they have a duty to make a good faith effort to settle, if it seems like you're probably going to be held liable at the end of the day, that can be used in tandem to kind of push the insurance company to settle, even though they're telling you that if there was a judgment against you, they probably wouldn't pay. So all of these things, they work together, and it can be a long process negotiating with an insurance company to try and get things taken care of, and so you don't have to worry about any of it at the end of the day. And all of these duties that they have can work together in that fashion. So an insurance company also has a duty to evaluate settlement offers as if it bore the entire risk. This kind of goes into the point we were just talking about, where an insurance company, they've got to make an effort to settle, even if they don't think that they would have to pay indemnity at the end of the day. They still have to evaluate the settlement offer as if it would have to pay no matter what. They also have an obligation to timely communicate any information they learn from their investigations and evaluations. And they have to tell you about any settlement offers they receive. Because a lot of times an insurance company has hired a lawyer to defend you. And that lawyer, what we call insurance defense attorneys, those insurance defense attorneys, they're not people who defend insurance companies. They're the people that insurance companies hire to defend their policyholders via the duty to defend. A lot of times those attorneys, they're getting paid by the insurance company. So they're often reporting first and foremost to the insurance company and less so to the insured you. I'm not saying that that's a bad practice or an improper practice, but the point is that they have to nevertheless tell you about the results of their investigations. They have to answer your questions. You are still the client to that attorney, and any settlement offers have to be conveyed to you. And the last component to the duty to settle is that if the settlement demand received exceeds the policy limits, so if you got a $1 million limit and the plaintiff demands $1.1 million, they've got to contact you and see if you're willing to contribute to the settlement amount. And the insurance company has to exercise good faith in deciding whether or not it should pay the full $1 million or whatever its limits are. Okay. Other duties. So those are the three primary duties, but an insurance company has other duties that they owe to you. Under Washington law, there's something called the Washington Administrative Code, which we call the WAC. And there's a portion of the WACs that identify what are deemed to be unfair claim settlement practices that an insurance company can do. And all of these things are, I've listed a few of the main ones here. So they have a duty to conduct a reasonable investigation. They've got whenever you make a claim, this is different from investigating the claim against you. They've got a duty to reasonably investigate your insurance claim. They've got a duty to have prompt communications with you. So if you send them a tender letter or any correspondence about your insurance coverage, they've got a duty to respond timely and quickly. And then the last one is that they have an obligation to make adequate and appropriate representations to you about what coverage is available. So they can't misrepresent policy provisions. They can't misrepresent the facts as they understand them. They can't misrepresent the law. And they've got to fully disclose all of your available coverages. And this actually comes into play quite a lot. I don't know if any of you have been involved in a situation where you've had a claim asserted against you and you tendered to an insurance company. If you'll often receive what's called a ROR, or reservation of rights letter back, which can be these very long 10, 15, even 20-page letters that mainly quote policy provisions, and they're very confusing. You're reading a bunch of insurance policy language, and I don't know about you, but even I, a coverage attorney, don't sit next to the fire and crack open an insurance policy for fun reading. It's dry, it's boring, it's not interesting. And I wouldn't be surprised if a lot of times people get these denial letters or reservation of rights letters, and they'll flip through them and they'll say, okay, well, I guess I don't have any coverage, or I guess my coverage might be limited this way. But the thing is the insurance company, might be omitting parts of the policy that is relevant to your claim that could help you establish coverage. And all of these things can be construed as a WAC violation, which can boost or support extra contractual claims under certain statutes like the Consumer Protection Act or the Insurance Fair Conduct Act. And those can entitle you to punitive damages. In the case of the Insurance Fair Conduct Act, or what's called IFCA, you could be entitled to up to 3 times your damages if the insurance company wrongfully denied or unreasonably denied your claim. So important things to keep in mind. And on that same note, the other duty that an insurance company has is a duty to act in good faith. And I've quoted a case called Tank v. State Farm, which is a pretty famous case in the insurance bar in Washington State, which talks about bad faith. And it essentially says an insurance company's duty to act in good faith is the same as their liability for acting in bad faith. So an insurance company can't act in bad faith. And there's a number of things that can happen to an insurance company if they do act in bad faith. I've included some materials on that later on. I know we've got a 2-hour time block, so I can kind of go as long as people want to listen. But if we get there, we can talk a little bit about bad faith and what all of that means. Okay. So talking a little bit about coverage issues that can appear in a general liability case. So the first thing to understand is that establishing coverage is really a 2-part process. And what I mean by that is the first thing that is done is a court or an insurance company is going to look at the insurance clause, the insuring clause, the language we looked at earlier, to determine whether or not you have coverage under the clause. That's the first step. So all of the language that we looked at earlier, and we're going to kind of parcel that out in a minute. They've got to figure out whether or not there's been property damage because of, or damages that you are obligated to pay because of property damage or bodily injury. If that's satisfied and that burden falls on the policyholder, the insurance company can start looking at the exclusions and say, okay, is the coverage barred by any of these different exclusions? And that's the way a court is going to look at any coverage dispute. Okay, so going through this process now, like I said, the first thing they look at is the insuring clause. And again, I'm sorry to put policy language in front of you. I know it's not exciting, but it is important to understand how most policy disputes, insurance disputes come and how they're resolved. A lot of them entail understanding or interpreting language in the policy, and that can be just a word. And I mean, I've actually had a case where the entire dispute rested on the absence of a comma in a single sentence. And I mean, we argued that the absence of the comma is, by nature of the absence of the comma, there was indisputably coverage under the policy. And the insurance company said, yeah, we kind of agree with that is how it's read, but it was just an accident, so you should ignore the fact that we forgot a comma. But I mean, it was an entire lawsuit about a comma, which is crazy, but it still does matter. And, you know, a quick war story on this one. In one of our legal briefs we wrote on that, we started by talking about, I can't even remember where we found it, if it was in another case, or it might have even just been like a meme on the internet. But there's something called the let's eat grandma principle. And the idea is there's a difference between the sentence, let's eat, comma, grandma, and the sentence, let's eat grandma, with no comma. You know, one is a pleasant meal with the matriarch of your family. The other one is an act of cannibalism. You know, there's a big difference between those two things. And I wish I could tell you how that case was resolved, but the motion for summary judgment on the comma was never, we never got an order on it because the parties settled before the order was given. So at any rate, I will try not to go on too many tangents there. So a couple of key phrases on this insuring clause. So the first thing is the insurance company is going to pay sums that you become legally obligated to pay. What does that mean? That's an issue that needs to be resolved. Another thing is, what does it mean for damages to be because of property damage or bodily injury? Is because of broad? Is it narrow? What does that mean? Another question is, what does it mean for property damage to be caused by an occurrence? Because the insurance is only going to pay if the damage was caused by an occurrence. So what does it mean for it to be for you to be legally obligated to pay? Well, traditionally, the only way you get this language that the insured is legally obligated to pay is if there is a settlement where you've inked your name and you said, I'm promising to pay someone. That's a contractual legal obligation to pay a certain sum of money. Or if there's a judgment against you at the end of the day, where a court has said you owe this subcontractor $100,000 because that's how much they're owed. Those are both legal obligations to pay. Where it gets a little bit more complicated is, are there any other situations where, by virtue of the law or the balance of the parties, whether you'd have an obligation to pay in that context? So, for instance, there's a case, and I believe it was Judge Robar out of Western District of Washington, where I think it's called either 100 Alki or 1000 Alki, but it involves a condominium association out, one of those ones that juts out onto the water in West Seattle. And the association was looking, and there was some sort of issue that they needed to fix. Can't remember if it was like danger of collapse from the piers, or maybe it was damage to the interior of the walls from the ocean water. But the condominium looked at the Condominium Act, the statute in Washington, and said, hey, we have an obligation to maintain and keep our common elements safe so as to not endanger the people who live here. And they said, this is a legal obligation for us to pay. And so they made that argument to the court, and the court agreed and said, yeah, even though nobody's suing you, nobody came after you to make these repairs, you're right. You do have a legal obligation to perform these repairs, and therefore the insurance company has got to pay you. And there's a couple of other cases to that effect, but that's the only one I'm aware of in Washington State. But still an issue on whether or not you can have a legal obligation to pay, even without a lawsuit. Another question is, what does it mean for there to be an occurrence? Well, most policies have a definition section that define occurrence to mean an accident. And that leads to another question. Okay, what is an accident? That might make sense pretty easily in the bodily injury context, where, you know, someone falls or something's dropped on them. More likely than not, that's an accident, unless they made some enemies on the site. And that would be something that would be deemed an occurrence and therefore potentially covered under the policy. But with property damage, it's a little bit more confusing. Is an occurrence, does that include, like, if I failed to properly flash the windows and I've got water damage coming into the siding or behind the siding and damaging the wall cavity? The answer to that question is yes. So in Washington, faulty construction has been deemed to be an accident. So anytime you have an insurance company saying, hey, you might not have an occurrence here, I would be highly skeptical of that. Okay, so what does property damage mean? That's another good question. This is a question that's actually defined in the policy. Policies typically define property damage to mean one of two things. The first is it can be physical injury to tangible property, and that's pretty self-explanatory. A hole in the wall is a physical injury to tangible property. You got water causing damage to the interior walls, that's physical injury to tangible property. Excuse me, I've got a little bit of a cold here today. I guess that's the hazards of having a 6 and 2-year-old. The other possible property damage is loss of use of property that's not physically injured. So that means there could be coverage even if something's not damaged, but you can't use it. That because of something, some sort of activity that's going on, that can constitute damage. And I'll tell you, there's been a lot of interesting case law about this definition of property damage over the last couple of years about whether or not exposure to coronavirus can constitute physical injury to tangible property or loss of use of property, not physically injured. Most of the courts have weighed on the side of saying, no, that's not property damage, but not all of them have. It's been interesting to watch unfold. Okay. The last one is, what does it mean to be because of property damage? Just as a quick reminder, so the insurance company is obligated to pay damages because of property damage. So the question I posed earlier is that a narrow term or is it a broad term? Well, Washington courts have defined because of to mean something very broad. So you're not going to just get coverage for the cost to repair the damage. You get other costs that arise because of the property damage. So a couple of key points here. This includes what we call get to costs. And what that means is, so let's say I'm sorry, I keep going back to the analogy of water inside a wall, but we live in the Pacific Northwest. That's what happens here. So somehow water's getting behind exterior siding and it's rotting out and damaging the sheeting and framing back there. The siding is fine. So you're going to have coverage for the property damage, right? The sheeting and the side in the framing. But what about the siding? You've got to rip that off in order to make the repair, right? In Washington law, those get to costs, the cost to rip out the siding and get to the damage so you can fix it and then put new siding up, all of that stuff is covered as damage because of property damage. Also, very important in the construction industry, because of has been defined to include consequential damages. So we're talking about liquidated damages, delay costs, which can be huge. And I mean, I can't tell you how many times the delay damage in a lawsuit I'm working on far exceeds the cost to repair. So that is a very important thing to understand, because a lot of times insurance companies will say in those letters to you, hey, we might not cover these delay costs because it's not property damage. And that's just, it's just not true under Washington law, with one exception. There are some endorsements out there, and we'll talk about what an endorsement is as opposed to the rest of the policy in a minute, that you should keep an eye out for, that will say something to the effect of, we won't pay for delay costs. So that can impact coverage there. You should keep an eye out for that, especially if you're working on big projects, because delays can be, through the roof. I don't know if any of you are familiar with the Stewart Street project that's been delayed for like 10 months now down by the REI in downtown Seattle. Those two twin skyscrapers that Graham Construction put up. The delay there, I actually have a case involved in that dispute, but it's much more minor. There's a huge dispute between the GC and the developer. I represent the excavator. They knocked into some utility ducts, and there was some issues there. It's a fairly decent dispute, but nowhere near the types of delays and issues that are going on with the other folks. So important to not have that delay exclusion in your policy if you're working on a big project like that. Okay, so talking about a couple of the exclusions in the policy, there's a couple ones to be on the lookout for, and they're interesting not just because they're issues that often arise in the construction industry, but also because it's really where you get coverage for ongoing operations and completed operations. So starting with what are called the J5 and J6 exclusions, and I'm sorry to use numbers and letters like that. I know it's not interesting, but the insurance companies do it, so I have to do it. So what's called the J5 exclusion, this excludes damage for property damage to that particular part of real property on which you or your subcontractors are performing work, are being a present tense particle there. The J6 exclusion says we exclude property damage to that particular part of any property that has to be fixed, that has to be, sorry folks, Apologies. So J6 excludes damage to that particular part of property that has to be fixed because your work was performed poorly on it. But there's an exception to that exclusion that says this does not apply to property damage included in the, and wait for it, here's another super complicated term that insurance companies came up with, products completed operations hazard. I honestly have no idea where that phrase came from, but that just means completed work. So if you're done working on a project, that's work included in the products completed operations hazard. So taken together, this present tense particle, the R, and this exception to the exclusion here means that these exclusions apply only to property damage that occurs during construction. So you're going to get coverage for, you can still get coverage under these for stuff that already happened, that your completed work can be covered here. Now, another important thing to point out, both of these exclusions talk about that particular part. We're excluding property damage to that particular part of real property. So going back again to the issue of what does that mean? That particular part has actually been defined by the insurance industry. They issue these things called ISOs that kind of help people understand what provisions are supposed to mean. And in it, they say that particular part means only the part of the property on which the operations are being performed. And I'll give you a couple of examples. The first is called the 5-beam example. And let's say you're erecting some steel beams in the course of putting up a building, and you put up 4 beams and they're perfect, they're plumb, they're well installed, no issues. And then you're installing the 5th beam and something happens, the 5th beam falls over and knocks into the other 4 beams, causing damage to all 5. Well, under these exclusions, you're not going to get coverage for the 5th beam that fell over because you were working on it when it happened. But the 4 other beams that were done, you will get coverage for that. Another good example is a counter cabinet. So let's say you're installing a kitchen and you've installed a beautiful granite countertop and all the cupboards underneath it. And then you're putting up some cupboards up top, and for some reason it falls down and smashes into the counter, causing damage to the countertop. You're going to not have any coverage for the cabinet, but you'll have coverage for the damage to the countertop that you already installed below. All right. Another important exclusion is called the your work exclusion. And I put this in here just to show you how awful insurance policies are. So this is the damage to your work exclusion. A little bit closer. So damage to your work exclusion, it excludes damage to your work, things that you do that are included in the product's operations hazard, which we'll talk about in a second. But there's an exception to this exclusion. It says this exclusion does not apply if the damage work or the work out of which the damage arises was performed on your behalf by a subcontractor. And that's very important because even though this exclusion is for damage to all of your work, the exception means that if you have a sub that performed the work, the damage to the work performed by the subcontractor is still covered as long as the subcontractor performed it, or damage to anybody else's work is also going to be covered if the damage occurred because of something the subcontractor did. And that's important for a couple reasons, because even though your work, damage to your work is excluded, you can still get coverage for damage to your work in 2 different scenarios. The first is if the subcontractor does something wrong, and like let's say you installed the framing and the subcontractor's a roofer, water comes down, damages your framing, then that is damage that arose out of the subcontractor's work, even though it's damage to your work. So you would have coverage for that. The other scenario goes back to the get to cost issue, where let's say you're the general contractor and you put on the siding, your framer did work and they did great work, and then you had a negligent roofer put on a bad roof, which again caused water to come down and damage the framer's work. Your work is the siding's perfect. You're still going to get coverage for damage to your work because the only way to get to the damaged framing is to go through your siding. Going back to this, the other part is that this only applies to damage included in the product's completed operation hazard. Again, that means completed work, which means that this, notwithstanding this exclusion, you still have coverage for damage to your work that occurs during your ongoing operations. So another question to understand is, what does it mean to be a subcontractor? Obviously, a subcontractor is a like if you're the GC, a subcontractor is a subcontractor. But a general contractor is also construed to be a subcontractor of a developer, which is an important point. There's subcontractors are subcontractors to a sub. So if you're a subcontractor and you hired a subcontractor, then you'd still be able to use that exception to the exclusion. And then there's an open question about whether or not a supplier can actually also be a subcontractor. And I've got a case here cited. It's not from Washington, but I haven't seen anything in Washington that goes against this law. And they essentially says that if a supplier builds something to a specific specification, and maybe if they went on site, that part's still not totally clear. But if those two pieces are there, then they can be construed as a subcontractor within that exception. All right. Another exclusion to kind of keep an eye out for is called the contractual liability exclusion. And this is an exclusion insurance companies will often cite to in denial letters or reservation of rights letters that says something like, hey, you got sued for breach of contract and we don't cover breach of contract claims. So, you know, there's probably not going to be any coverage here. And this is problematic for a couple of reasons. Number one, that's not consistent with the law. And more importantly, if you're a contractor and you get sued, you're going to get sued for breach of contract, because in Washington state, there's no viable claim against a contractor for negligent construction. That's just not something that you can sue for. So these exclusions typically say something like this: the insurance does not apply to property damage for which the insured is obligated to pay damages by reason of the assumption of liability in a contract or agreement. There's always an exception here for liability assumed in an insured contract. And an insured contract is typically considered a contract under which you assume a tort liability of another party. So an indemnity agreement. So in other words, this is not going to exclude coverage for your a standard indemnity agreement in a contract. On top of that, what does it mean to be liability assumed in a contract? Well, at least the Fifth Circuit thinks that an assumption does not include a breach of contract claim. And I'm not aware of any Washington law that says otherwise. The rationale here is that if a policyholder, when they get a breach of contract claim, they're not getting sued as a contractual indemnitor of something that they assumed. They're being sued for their own conduct, which is alleged to be negligent. And that rationale is logical. It makes sense. I'm not aware of any counter argument to that. And I think that would probably be a strong argument to make in the state of Washington as well. And this goes back to a point I just mentioned. The point of the carve out, the exception, is to preserve coverage for a standard indemnity clause. So bottom line is, these contractual liability exclusions, while they're often cited in letters you receive from an insurance company, the actual impact of them is generally fairly minimal, especially in the construction industry. Okay, so now let's talk about what are called endorsed exclusions. So the way a policy typically works is, if you get your policy, you'll have what's called a declaration page, and that'll tell you all your basic information, your policy period, your deductible, and your policy limits, stuff like that. Then it's followed by a primary form, which has the insuring clause that we talked about, and then a litany of exclusions. And then it usually ends with like a definition section where some terms are defined and some terms are not. After that, depending on how your policy is put together, you'll have what are called endorsements, which are like 1, 2, maybe 3-page things that add additional coverages or take away coverages by adding additional exclusions. And so there are also things that you really need to keep an eye out for. And I've kind of highlighted over the next several slides some what I consider to be very important endorsements to keep an eye out for, because they're going to massively impact your potential coverage. Now, the first one I think is really important. And again, I'm really sorry to use these numbers. So most policy forms, most policy endorsements have form numbers. They usually appear in the bottom left or the bottom right. And this is a form you should absolutely write down. You should be aware of its existence. It is a new trend. I've just recently, I think the first time I saw one was maybe like 3 years ago, but I've seen several since then. And what this does is it deletes the subcontractor exception to the your work exclusion we were just talking about. And what that means is that your work is going to be, damage to your work will be excluded no matter what, which can be a huge problem. Every time I've seen one of these cases with that exception in there, I mean, it tanks coverage. I mean, you don't have coverage for damage to your work, and you've got a huge issue. Now, that doesn't mean that you're lost. There's the insurance bar on the policyholder side, including myself and the members of my firm, have some arguments about why this policy language should be unenforceable altogether, but that just hasn't been litigated. So it's unclear how that would shake out at the end of the day. But bottom line is, you should absolutely be on the lookout for this. And under no circumstances should you allow this endorsement into a policy that you're using. It's also going to take any coverage for completed operations. So you're going to have no coverage for damage that happens after your work is completed. So just definitely keep an eye out for that. Another endorsed exclusion that pops up, it's been around longer than that one, or what we call continuing damage exclusions. And these will say something like, we will only cover damage that starts during our policy period or commences during our policy period, or we will not cover any damage that first started before our policy period. And this is typically applicable to those ongoing losses, which again, in the Pacific Northwest happens all the time. You get some small defect somewhere on the building envelope, and water's getting behind the siding and nobody knows about it. And it's something that goes on for years and years, and then you uncover it and you find, you got a huge problem behind the siding, and it's going to cost millions of dollars to fix. So under these circumstances, what you get is a situation where you might not have all the limits you need to resolve the action. And I don't know if this is 1-point font. I'm sorry if you can't read that. This is more for, I stole this graphic from my colleague Todd Hayes, so I didn't write it in really tiny font. But at any point, this is more for visual purposes anyways. Let's say each one of these bars represents a policy year. So this says 2014 to 15, 15 to 16, 16 to 17, and 17 to 18. And each one of these has $1 million limits in them. And if these two policies, let's say a loss, an ongoing loss starts here in this policy, and it continues all the way through here, and it's discovered somewhere here. And if these two don't have the endorsement I just referred to, but this one does, and says, hey, we don't cover damage that commenced prior to our policy, and then this one doesn't have that language, what's going to happen is you're not going to get any coverage under this policy. You'll get coverage here, you'll get $2 million, you'll get another $1 million here, but you're going to have $1 million that doesn't apply because the damage started somewhere before this one. So just another one to keep out for, because the result, if you've got this, is if you've got an ongoing loss, which really is a very common thing to happen here in Washington, you're going to have less limits to pay for the damage, to settle the issue, to get the problem off your back. Okay. So another type of policy that you should be aware of, if any of you have worked on a large project, you might be aware of these. They're called wrap-up policies. Sometimes they're called OSIP, or owner-controlled insurance programs. And what these are is, you'll probably still have your own insurance, but typically it's the owner or developer goes out and they buy a massive umbrella policy that's intended to cover every single contractor on the project. And the result is kind of has some funky changes in how the thing works. So typically it's going to insure all the parties to the project. It's often going to delete the your work exclusion in its entirety, which means this isn't the exclusion thing that I was telling you to be worried about. It deletes the exclusion. So damage to your work is no longer an issue. So that means that you're going to have coverage for completed operations. So when you're done with the project, you'll still have coverage for it. Sometimes, I mean, anytime you have an issue on a project, you usually have a lawsuit between different contractors. So maybe the general contractor sues a sub, and the sub sues 3 of its subcontractors, and the owner's involved. You've got all these parties pointing fingers. So what happens then when everybody's insured under the same policy? Well, the important thing to remember is that under these insurance policies, every single one is every single insured, every single policyholder is entitled to a separate counsel. So it's always important, if you find yourself in one of these situations, to insist on getting your own separate counsel, because if you don't have that, you can have a potential conflict where one attorney is representing the GC and the subcontractor who are pointing fingers at each other. GC is arguing, hey, you messed up and caused all this damage, and the subcontractor saying, yeah, but you didn't pay me, because a lot of times when these things happen, the general contractor will stop paying while the dispute's getting resolved. So always important to have different counsel. The other thing to watch out for, and I know I put this under the wrap-up policy slide, but this really applies everywhere. Watch out for what are called wasting policies, or sometimes eroding policies. What these policies say is they'll say something like, we will defend you, and we have a policy limit of $1 million, but just to let you know, every penny we pay to the attorney to defend you is going to take away from the policy limit. So I would say most policies do not include this language, but if it does, it's going to mean that, maybe it costs the insurance company pays an attorney $150,000 to defend you for 1.5 years. Then instead of having $1 million to resolve the lawsuit, you've only got $850,000. So it's important to keep an eye out for these policies, preferably not have them, because you want to have your defense obligation, which is, you get a defense and it's going to cost however much it's going to cost, and it shouldn't have any impact on how much money is going to resolve the case at the end of the day. And then you'll have your full policy limits to resolve the case, either by settlement or judgment, whatever. If you do find yourself in a situation where you have a wasting policy, then one thing you should do is try and encourage and insist on an early settlement. Going back to the duties we talked about, an insurance company has a duty to attempt settlement, especially if it seems that you are liable. Remember, the more time a defense attorney takes to defend you, you're losing money from your limits. So if it's pretty clear you're liable and everybody acknowledges that fact, then the insurance company should step in and settle as soon as possible. So you'll have the biggest benefit of the policy limit to resolve the case. So that's a really important thing to watch out for. Okay, why don't we take a 5-minute break?
You want to get started again?
Absolutely.
Okay, sounds great.
I know everybody's waiting for another riveting hour of insurance.
This is helpful. This is very interesting. Like when you're in it, it's a lot is starting to make more sense.
Well, I will tell, when I was in law school, and even after I was in law school, I started practice, the last thing in the world I thought I would end up doing is practicing insurance law. I didn't take any insurance law classes. I mean, that's not something that I thought was going to be fun or exciting. But I really enjoy it. I practiced a lot of different areas of law for the first couple of years, and I didn't think anything was interesting or as exciting. I know sounds weird, but
Yeah, it's good.
it's exciting. We like it.
That's
All
great.
right. I appreciate your comments. All right, let's see. Okay, so you might remember at the very, very beginning of the presentation, I was talking about the two different types of insurance. There was liability coverage, which is where you've been sued or somebody's made a claim against you. And that's what we've kind of been talking about so far today. The other aspect is the property insurance, where you have a claim because like a part of the project, maybe some materials you had resting on the side or materials that have already been incorporated in the project get damaged, and you have a claim directly to your insurance company for coverage for that damage. And the insurance company is going to pay you. They're not going to go and pay somebody else. The money is going to go to you. And the most common form of insurance for contractors is going to be your builder's risk insurance. This is insurance for property that is under construction. So, it's coverage for the project is basically what it is. Typically, builder's risk is going to insure all parties, kind of like the OSIP and the RAP policies we were talking about. So everybody that's working on the project. Typically, these policies are what are called all risk, which is interesting. What that means is that it's going to cover any type of thing that's not excluded. And a long time ago, policies used to be what are called known peril policies. So what it would do is it would say, we'll cover you for property damage, and it'll say if one of these things happens. So we'll cover fire, we'll cover lightning, we'll cover damaged by snow. And those were the only things that were covered. It's been flipped. So now what it is the policy lists the things that are excluded. So we will not pay for flood or we will not pay for water seepage that occurs over a span of 14 days. Those are common types of exclusions you see these days. Everything else that's not listed is covered. So, the most common example thing that's almost always covered is fire. So you're never going to see anything in a builder's risk or property policy that says we exclude fire, because it's not excluded. That means that it's covered. And that's how the all risk policy works. But that can end up being another huge mental exercise into determining whether or not, if the policy says we exclude this, does that encompass something else? So the classic example from the Washington Supreme Court gave is if a policy excludes fire, you can't get coverage for really hot flames, right? Those two things are one and the same. They are not distinct perils. It gets a little bit more tricky when you're talking about I'll just give you an example. So one argument we come up with a lot is most policies include they exclude damage caused by water. And then water is defined to mean things like flood and like mudslide and things like that. And then it'll say water that seeps into the building from below the ground. So that is excluded. Water that bubbles up from a drain is excluded. But that's all it says. So we've argued many times successfully that because the policy doesn't exclude damage to water above the ground, that seeps in from above the ground, it only excludes water that seeps in from below the ground. Those two things must be distinct, and above ground water seepage must be covered, because this is an all risk policy and it doesn't exclude it. It only excludes water that seeps in from below. So those are the kind of things that you have to figure out with all risk policies like this one. The other thing to remember about builder's risk policies and actually all property policies, honestly, is they typically will exclude damage for faulty design and workmanship, which can be a problem because a lot of times that's why the damage occurs. However, these exclusions always have what's called an ensuing loss clause. And what that means is if faulty design or faulty construction or faulty workmanship initiates a loss where that happens, but then it causes something else, which then causes the damage, and that something else is covered, then you're covered. So, like I said, most policies cover fire. So if faulty, let's say an electrician does something faulty and they do bad workmanship, and a week later there's some sort of spark and ignites a fire and the fire burns down the property. Even though faulty workmanship is excluded, because that led to a covered event, a fire, the whole loss is going to be covered. Okay. A lot of times these builder risk policies include what's called a subrogation. Well, I'm sorry, excuse me. A lot of times your contract in a construction project is going to have what's called a subrogation waiver. And it'll say something to the effect of, the owner, developer, and the general contractor, they're going to waive all their claims against each other for damages if it's covered by a builder's risk policy or some other property insurance. And that also is in most GC subcontractor contracts as well, a subrogation waiver. So that leads to the question, what if damage is covered under the builder's risk and the CGL policy? What if it's covered under both and you've got this contract provision that has this language? And I'll give you an example for how this could come into play. So let's say a subcontractor is working on a pipe and the pipe breaks and it causes damage to some other subcontractor's work there. The owner then sues the general contractor for liquidated damages, delays, the cost to dig up and repair the work. And the owner and the general contractor have a builder's risk policy, but they also have a contract with a subrogation waiver in it. Who's going to pay first? Is it going to be the builder's risk insurer, or is it going to be the liability insurer with this lawsuit that's been brought between the general contractor and the owner? The way this is worked out in Washington State is basically, and this is from this Shea Valley case. This is a quote from the Washington Supreme Court. If there's a subrogation waiver, that basically means that you've got to figure out whether or not the property insurance covers it first before you look into the liability. So if you're involved in a lawsuit between two parties, and you've got a subrogation waiver, the first thing that you want to do is kind of put that lawsuit to the hold to try and figure out whether or not there's going to be coverage under the builder's risk policy or the property policy. Let's see. Another issue that could come up is, okay, well, maybe the builder's risk policy does provide coverage, but what if it doesn't cover everything? Just never lose sight of the fact that there could also be coverage under a general liability policy. Even if nobody's brought a lawsuit against you or you haven't brought a lawsuit against somebody else. And by the way, in these construction cases, a lot of times people actually file lawsuits like they agree, like, hey, you should sue me so we can get, like, because I have insurance coverage, and then maybe that'll trigger a way to pay for this. And that is an acceptable way to get at coverage. So just don't forget that your general liability policy can provide coverage for property damage. Other than that particular part that you're working on, it can provide coverage for your liquidated damages. DeWitt is a Ninth Circuit case. That's where that rule came from, that consequential damages. And that was that case was actually achieved. Todd Hayes was the guy who argued at the Ninth Circuit of the Harper Hayes on that case. And then it also is going to cover your get-to costs, also your rip and tear costs. That means one and the same. And the TG construction, that's the case that establishes that. Okay, another issue comes up is, what if there's claims, like cross claims between the parties? So let's say you've got the owner has $1 million property damage claim against the general contractor, but when the general contractor did whatever it did wrong, the owner just stopped paying the general contractor. So the general contractor says, hey, you still owe me $300,000 for the work that I've already performed. How does the insurance come into play there? Is the insurance company going to pay $700,000 because it gets to take a discount? Because the net here, right, is if these are accurate numbers, $700,000 should go to the owner and the GC should walk away, right? That's not the way it works in insurance law. The general contractor's insurer should pay for its liability the $1 million, not $700,000, because the insurance company should not be entitled to $300,000 that the general contractor is entitled to because of something the owner did, failed to pay or whatever. The insurance company, they insure against liabilities for property damage. If the liability there is $1 million, they should pay $1 million. They should not get the benefit that the general contractor has, the benefit of the general contractor's claim for work that it's done. That doesn't make any sense. Where this really gets a little complicated is, what happens if, let's say, the insurance company wasn't involved for one reason or another? And I'm actually involved in a case like this right now, where the insurance company denied, and there's a lawsuit saying, hey, you wrongfully denied. But while the insurance lawsuit is getting figured out, the dispute between these folks is resolved, and the general contractor and the owner enter into a settlement agreement where $700,000 goes from the general contractor to the owner. Does that mean that the insurance company just pays the $700,000? No, it doesn't. This is a case from California, and there's other cases like this. There's nothing in Washington yet. There's several treatises that have been written by insurance experts, and I've never seen anything that says otherwise. The answer is, if a insured, a policyholder, gives up something of value to resolve a case, the insurance company owes that value. And I'm not going to just read this case law to you, but that's essentially what it means. If you give up something of value to resolve a case, the insurance company should not receive the benefit of what you gave up. The insurance company entered into a contract. They agreed to cover you for damage losses. If you had to throw in money to resolve that claim, like if you threw in $1 million, the insurance company should pay you $1 million. If you only threw in $700,000, but you also gave up a claim that was worth $300,000, then the insurance company should still owe the full $1 million. Okay, let's talk a little bit about additional insurance. So if you buy a policy, you are what's called the named insured. In construction industry, you're also often named and insured as an additional insured under other folks' policies. This is particularly true of if you're a general contractor. So generally what happens is you have a developer who hires a general contractor. The general contractor's got their own liability policy. And then the general contractor also hires all of these subcontractors. All of those subcontractors have general liability policies. And typically, your contract between the general contractor and the subcontractor is going to say something like, hey, subcontractor, you have to make sure that your insurance company adds some language to make sure that I am an additional insured and entitled to coverage under your policy. So assuming the subcontractor does what it's supposed to under the contract, you're going to have additional insurance here. You're going to have your own insurance here. And the question is, what should you do if something happens? You're insured under both of these policies. Well, this is not always the case, but I think a lot of times it makes a lot of sense to not tender to your own carrier, even though there's money there, but instead to tender to your subcontractor's liability carrier. there may be any number of reasons you'd want to do that. That could help it so maybe your premiums don't go up. It could make it so maybe you have like a big limit of $10 million, and it's over a course of a couple year period of time. If you use all that money now to resolve this case, if something comes up 5 months from now, maybe you're not going to have that limit to help you resolve another case. So it often makes sense to tender just to your subs carrier. And this could change. I mean, if the liability you're facing is tens of millions of dollars and your sub's only got $1 million limit, maybe it makes sense to get every bit of insurance on the table all at the same time if you're really afraid of the liability. But it's just another thing to take into consideration anytime you're involved in one of these types of cases when you are named as an additional insured. Now, some tips on how to make sure that additional insurance that you have is as ironclad as possible. Your contract with your subcontractor or anybody else that you're trying to name you as an AI, that's additional insured, should say that the AI coverage is primary and non-contributory. That's going to do a number of things. First, it's going to mean that the named insurer, so the subcontractor's insurance company, is going to step up and they're going to defend you. Second thing is that insurance company that's defending you, they are not going to be able to seek contribution from your insurance company. They cannot do that. It's also important to make sure that the endorsement in the policy says that this is how it works. And to that effect, it's really important to get the endorsement. And I can't stress this enough. Most contractors, as far as I'm aware of, when they enter into a contract with a subcontractor and say, hey, make sure you name me as an AI, the only thing that they ask them to provide is a certificate of insurance. The 1 or 2 page certificate of insurance that says, hey, so-and-so is now an additional insured. And honestly, things are starting to change a little bit on this front. There's a case recently that we'll talk about in a minute that has changed it. But prior to that case, I would say that a certificate of insurance is about as valuable as the piece of paper that it's written on. It's much more important to get a copy of, get a copy of the entire policy. But even if you don't get a copy of the policy, in the very least, get a copy of the endorsement that names you as the additional insured, because that way you will have a better understanding of whether or not all of the things that are necessary to protect you are properly in place in case something does go wrong. And if something's not right, you can make sure you get that fixed before something goes wrong. Knock on wood, hopefully nothing goes wrong. But that's what insurance is all about, is making sure you're protected if something does. Okay, another thing to look out for on additional insured. Not too long ago, I know this is olden days, but not too long ago, typically if you had an AI endorsement naming you as an additional insured under somebody else's policy, you'd have coverage for ongoing operations, for completed operations. You'd have coverage no matter what. Fairly recently, that's been split up. And now it seems like you got to get 2 different forms. So you got to get an ongoing operations form. And I provided the form number here just so, you can write that down, give it to your broker, say, hey, here's what we need. An ongoing operations is one, and it'll say no coverage for post-completed operations. And then there's a different AI endorsement that says completed operations, and it says no coverage for ongoing operations. So in order to have coverage for both, instead of having to get just one endorsement like we used to, you got to get 2 different endorsements, usually. I think there's still some policies out there that put out AI endorsements that cover both. But for the most part, this is the big trend going on right now. So if you want to make sure you've got coverage for both ongoing operations and completed operations, you got to make sure that you've got both of these endorsements in your subcontractor's policy. Okay, so here's so moving away from the additional insurance thing, some more practice pointers. So liability coverage is going to depend, whether or not you have liability coverage depends on when the damage occurs. So earlier we were talking about ongoing operations, for example, or ongoing damage, for example, that, water damage that's been occurring for years and years. That's not always what happens, right? Maybe a leak springs 3 years after you walk away from the project. To make sure you've got full coverage and you're not going to end up in a situation where a loss occurs and you've got no coverage, it's important to buy or require your subcontractor to buy liability insurance after the project. And generally, this is language that you can add to your contract. Generally, you want to make sure that you're going to get it for 6 years or through the statute of repose, whichever one is longer. And that will make sure that if anything happens in that time period where you could still potentially be held liable, you'll have coverage. But once both the 6 years, which is the statute of limitations on breach of contract, passes, and the statute of repose, once both of those two things pass, typically I'd have a hard time seeing you facing a lawsuit. So that's why you should make sure there's coverage for that period of time. Separate point, and I said it before and I'm saying it again because it's important, don't allow this endorsement into your policies. The CG 2294 is the one that deletes the subcontractor exception to the your work exclusion. If that goes in there, you will never have coverage for completed operations work. That's what happens as a result. So that's a big one to look out for. And again, I talk about how boring these policy form numbers and stuff are, and I mean they're complicated. But if anything I'm saying makes sense to you and you want to make sure that you've got the coverage you need, just write these numbers down and then hand it over to your broker and just say, hey, I want to make sure my policies don't have this. Can you make sure they don't? And if they do, can you fix it? That's why I include these form numbers, not to bore you, but to make it easier for you to just hand over the problem to the broker. And to that point, when you're writing contracts or you have your attorney write a contract, it's always helpful to use form numbers. Something like, hey, use ISO form blah, 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 or the equivalent to it. That will make sure that if there's a certain type of coverage that you want to make sure is in your policy or in your subcontractor's policy that you're going to be an additional insured on, that'll make sure that they have the right coverage that you require. And again, you can get form numbers from your broker, tell them what your priorities are, tell them that you don't want things like the endorsement we just talked about that gets rid of the subcontractor exception. Hand them those, say, I just want to make sure these types of things are not in my AI policy. So can you get rid of them? Get the right proof of insurance. This is what we just talked about. You want to make sure that you get at least the endorsement or ideally the whole policies. And then another point, if you do get sued, one thing you might want to consider is selectively tendering. This is similar to the point we talked about just a minute ago about figuring out who you want to make a claim to, your own insurance company or maybe your subcontractor's insurance company if you're an AI. And I'll give you another example of why you might want to do that, even if it's just your own policies. So going back to the impossible to read graph, let's say you've got an ongoing loss that goes on for 4 years. But each of these policies have $1 million limits, and the loss is going to be like 800,000 max. So any one of these policies is going to cover everything. You might want to only tender to this one right here, the Zurich policy, because this blue bar I have at the bottom is representing an SIR, a self-insured retention, or a deductible, where you have to pay the first $100,000. You might have a policy in the mix where you don't have to pay a dime to trigger coverage. There's no deductible, no self-insured retention. So in that case, if you've got an $800,000 dispute and you got $1 million worth of coverage on all 4 of these policies, why not tender to the one where you don't have to pay $100,000 to start the coverage? So that's another thing to look at. And that's called a selective tender. Most policies allow you to do that. And then if you do selectively tender, usually the other insurance companies can't go after your other insurance companies. They're prohibited from doing that. For the same reasons that you can selectively tender, you should be able to selectively detender. So maybe you just tendered to a bunch of insurance companies yesterday and you're learning this today. You could reach out to your company and say, hey, I don't want to make this tender anymore. I am withdrawing it because I don't want to pay this deductible amount and I'm going to go after some other insurance company. That you should be allowed to do that. It's technically still a gray area under the law, the Washington law, but it would be a tough one for an insurance company to say you can do that. Now, there is a difference between tendering a claim and giving notice of a claim. So going back to this graph, even if you only want to tender to this one, so you don't have to pay a deductible or self-insured retention, you should still give notice to all of these insurance companies, because most policies have a conditions section that can impact whether you have coverage at the end of the day. So where insurance companies say, hey, I don't have to pay because my policyholder, they breached our policy. They didn't timely notify us of the claim. You can give them notice without tendering, and you should give them notice because that will preclude them from arguing that you didn't give them timely notice. If, for example, the $800,000 loss unexpectedly balloons and suddenly it's a $3 million loss and you need to trigger all of those policies, you can tender at that point and they won't be able to say, hey, no, I don't owe anything because I didn't get timely notice. So always give timely notice to all of your insurance companies that could potentially owe coverage. That point is particularly important if you're talking about a professional liability policy. I don't think we really talked about that. That's another type of liability policy. We mainly talk about general liability policies. Professional liability policies are typically policies that cover architects, people associated with the design of buildings, architects, engineers, things like that, for negligence in the performance of their professional duty. And those policies are kind of weird. They're typically called claims made policies, where they're not triggered by when the damage occurred. They're triggered by when you report the claim. So if you don't timely give notice, then you might lose an entire policy period under a professional liability policy. All right, last topic for the day, and I'm just going to kind of breeze through this, and then we can do some Q&A if you guys want to. I want to talk to you a little bit about insurer bad faith, because most of today I've been focusing on how to make sure you don't get into hot water, how to make sure you've got the best coverage you can have. But even if you have the best coverage that you have, an insurance company, that doesn't stop an insurance company from doing naughty things, for lack of a better term. I mean, insurance companies, it's hard for me. I don't want to judge. I'm sure there's great insurers out there. I'm sure there's great insurance adjusters out there. But like a doctor, right? People only come to me when their insurance company's done something wrong. That's what I see all day, every day. And I have seen things that I'm like, oh, maybe that's wrong. Maybe it's not. It's a gray issue. We should look into this. But I've seen things that I cannot believe an insurance company took this position or didn't tell somebody about this coverage that they had. That kind of stuff happens all the time. And when that happens, it's important to, number one, be able to recognize it. And number two, understand what benefit you could get at the end of the day because of what happened to you. Maybe I shouldn't be construing it as a benefit, more like what remedies are available to you when that kind of thing happens. A better way to put it. So first, what is insurer bad faith? Well, we've been talking mostly about contractual liability. So if an insurer breaches their promise made in the contract by refusing to defend a covered claim or failing to pay a covered claim, that's a contractual claim, and you have a breach of contract claim against your insurance company. And under that claim, you're entitled, if you win, you're entitled to the coverage you're owed. The other type of claim is what's called an extra contractual claim or extra contractual liability. And this is where the insurer engages in some sort of wrongful conduct. So this is where they don't just breach the policy, they unreasonably breach the policy. Or they have negligent claims handling practices. They don't timely respond to you. They don't tell you about a settlement offer. They don't fully disclose all the coverages available. That's another one. And then third, they can be liable for violating a statute. And I briefly mentioned them earlier. There's two in Washington to be aware of: the Insurance Fair Conduct Act, or IFCA, and then the CPA, or Consumer Protection Act. So generally speaking, Washington is pretty policyholder friendly. I think I quoted this tank case earlier. This is how they've kind of defined bad faith. They've said an insurance company's duty of good faith rises to an even higher level than that of honesty and lawfulness of purpose towards its policyholders. An insurer must deal fairly with an insured, giving equal consideration in all matters to the insured's interest. And I find that to be a pretty high standard that an insurer must aspire to, which is not always met. There's many different types of bad faith conduct. There's an unreasonable denial. So typically a denial of coverage that's deemed unreasonable, which is usually up to a jury to determine whether a denial is unreasonable. That would be bad faith. There's putting their own interest first. Under Washington law, an insurance cannot put its financial interest before the interest of its insured. For an insured to do so, that is an act of bad faith. And also there's cases that say the same thing without the term financial. So an insured just cannot put its interest before its policyholders' interests. An insurance company cannot rely on questionable issues of law. So if they refuse to defend or deny coverage based on a questionable interpretation of a law, I mean, at least in this case, it was found to be bad faith as a matter of law. And then a failure to promptly pay can be a unreasonable denial of benefits, which constitutes bad faith. So what's the point of bad faith? What kind of remedy does it open up for you? The first one is pretty important. So we talked earlier about how it's really hard for an insurance company to not owe a duty to defend, but a duty to indemnify is much harder because the claim actually has to be covered. Well, if the insurance company denies its duty to defend in bad faith, under Washington law, it is estopped. That means it cannot deny indemnity coverage. So if they deny duty to defend in bad faith, it will have to pay the full indemnity amount at the end of the day, even if there's no coverage under the policy. That is a huge remedy. Anytime you have an issue with a duty to defend, and by the way, this is not just an insurance company says no. I had a case last year where an insurance company didn't say no, they just didn't say yes for 7 months until I got involved and I wrote a letter to the insurance company threatening an IFCA claim, which we'll talk about in a second. And then they woke up and said, "Hey, we'll pay now." But at this point, my clients had already been defending a lawsuit for 8 months, had been out on their luck, and we were arguing. Look, this was a constructive denial of the duty to defend, even though they never said no, there was no duty to defend. This is in essence a denial of the duty. We don't have to accept it this late, because at this point we already have our own attorneys involved. We don't want the insurance company to swap out attorneys. It's going to complicate the case, give control over the insurance company. No, you just owe us the money that we've paid our attorneys, and you owe us whatever the damages, the judgment against us will be at the end of the day. We ended up settling that case. But the point mean is that is a viable argument. It's a strong argument if that's something that happens to you. The insurance company doesn't have to say no for them to deny coverage that you're entitled to. And then there's also statutory remedies under bad faith. So the Insurance Fair Conduct Act, and this is the big one, if an insurance company denies coverage under, if they unreasonably deny a claim of coverage, they can be subjected under this statute up to treble damages. So if you get sued and you pay out $500,000 in attorney's fees and then another $500,000 to end the case against you in a settlement, so you paid out $1 million, the insurance company could owe you up to $3 million. Those are punitive damages. Similarly, the Consumer Protection Act allows up to treble damages, but then it's capped at $25,000. So that's not as powerful as a mechanism, but it's still something. And then the other thing to know about both the Insurance Fair Conduct Act and the Consumer Protection Act is if you show that either of those statutes have been violated, then you will be entitled to all of your attorney's fees. So any money that my client pays me to get coverage for them is another penny that they can get back because the insurance company violated one of these two statutes. And notably, there's also common law that says if you have to sue an insurance company to obtain the benefit of your policy, you're also entitled to your attorney's fees incurred in the insurance lawsuit. So again, all of this reinforcing the statement earlier that Washington State is a very policyholder friendly state. If you get into a dispute with your insurance company, there's a lot of different ways for you to recoup any attorney's fees you incur in that fight with your insurance company. All right, this is my last slide. So just wanted to kind of give you a quick breakdown of some recent case law that I think are important both in the insurance and in the construction industry. So the first one is West Beach Condominium Association versus Commonwealth Insurance Company. This is one of the cases that we just recently had. It went up to the Division I of the Court of Appeals. And the issue was most policies have what are called a suit limitation clause that says, hey, you've got to sue us within 2 years after you discover the damage. And we were approached by a condominium association something like 2.5 years after they discovered damage. So the suit limitation clause had passed. And so we filed the lawsuit anyways because they denied coverage based on that suit limitation clause. And our argument was, look, insurance company, I get that we don't have a breach of contract claim against you because you have the suit limitation clause, but just because we don't have a contract claim against you doesn't mean there's no coverage under the policy. And the court agreed. Well, the trial court did not agree with us, and then we appealed it to the Division I, and Division I agreed with us and said, yes, you're right. The suit limitation clause does not affect coverage. You can still have coverage. And by the way, it also doesn't affect remedies under the IFCA statute or the Consumer Protection Act statute. So, and you can recover your entire loss under either of those two statutes. So, and you can get punitive damages. So this was a pretty big case because for many years, insurance companies had denied coverage based on suit limitation clauses. And this basically says you can't do that anymore. And by the way, that case, the insurance company appealed it to the Supreme Court, and the Supreme Court denied review, which means that they reviewed the opinion by the appellate court, and they said this is good. So, I mean, this issue is resolved in Washington law. Another recent case is what I kind of mentioned about the certificate of insurance. So the reason I say certificate of insurance is not really very valuable to have is that they are peppered all over the place with these caveats that say, hey, here's a certificate of insurance. It says that you're an additional insured under so-and-so's policy, But just to let you know, if the policy doesn't say that, then the policy is going to trump, and this thing will be essentially null and void and will be meaningless. This case, T-Mobile, I can't remember the insurance company. I think this was 2019, maybe 2020, says that no, these certificates of insurance, that all that form language, that stuff's essentially null and void. If the certificate of insurance says that this guy is insured, then they're going to be insured. So the certificate of insurance still has more value than it used to, but it's still better, that said, to have the full policy, or at least the AI endorsement if you can get a hold of it. The other case, this next case, I don't know how to pronounce that, apologies. But it's a recent case about coronavirus. This is out of the Western District. Judge Rothstein recently issued this opinion, and she said that coronavirus does not cause physical loss of property. That's not binding law, because it's federal court. Only the state court can issue binding law in Washington court. So it's not, the issue is not foreclosed in Washington, but it is persuasive authority. So that's the current state of affairs on coronavirus. And then this Taddick case, you want to talk about recent case law. This came out, I think it was on Halloween. Very, very recent case. But I think it's really important, especially to any of you folks who do work with single family homeowners. You're not working on big, huge projects. So essentially, a lot of contracts often have a suit limitation clause like the one I was referring to in the insurance case, but it'll say something like, you can't limit typically there's a 6-year time frame to sue for breach of contract, and maybe the contract will say, hey, we're going to limit to 1 year or 2 years. And the court basically said, you can't do that in these situations because it's form language. You're dealing with an unsophisticated party. A homeowner typically doesn't understand what this stuff means. And if there's no negotiation and it's only benefiting the contractor and it's not benefiting the homeowner, then there's no bargain for an exchange, and this part of the contract is void. So if you've got that type of form language, you might want to talk to your attorney who helps put those contracts together about whether there's a different way to approach it, because that seemingly is no longer. This is from the Supreme Court of Washington, so it's not. It's the Court of Appeals. So I guess the Supreme Court could still overturn it, but as of right now, this is binding precedent, and those types of forms, especially dealing with homeowners or other, unsophisticated parties, not taking a dig at a homeowner, those types of provisions are not necessarily enforceable anymore. And that could apply to other types of form language in there too, by the way. There's oftentimes there's a language that'll say, we'll cap, we'll pay anything we did wrong. The most we'll ever pay is the amount of the contract price. So, you paid us $100,000. That's the most you're ever going to get back from us. Our liability is going to get cut off at that. I question whether or not those types of provisions and contracts are still going to be enforceable in light of this decision. So more food for thought. And that's it, everyone. I appreciate you being here with me today to talk about insurance, something I care about, and most people, probably you, don't really care about that much. But I do appreciate your time, and I'm here for you to ask me any questions. I think I mentioned earlier that I will be at the ABC event for the Top Golf down in Renton tomorrow evening with the rest of the members of my firm. If you want to come talk to me, ask me questions, or just say hi, feel free to do that then too. We'll be there. And with that, I will pass it back to Sophia. Anybody's got some questions, let me know.
Tom, thank you so much. I learned a lot during that, and I'm grateful for that knowledge. We recorded this. We're going to put this webinar on the ABC resource page for members, and then we're going to send, I think we're going to send a a link to it in News of Merit this week, so it'll be out on Monday, as well as Tom's contact information in that. Before we wrap up and end, does anyone have any questions? And if you don't feel comfortable asking, feel free to send me an email and I can connect you with Tom.
Or you can send me an email.
Thank you.
You've seen my email on the page here too.
Even better.
Feel free to shoot me an email. I'll try and get back to you as soon as I can.
All right. Well, if there's not anything, thank you all so much for joining today. And again, Tom, that was a huge benefit for our members and a huge resource. So thank you so much for your time today and for going over all of this. It was really helpful.
Yeah, absolutely. My pleasure. Anytime.